Let's talk about this new product, which enables your customers to open an account, as I understand it, seed it with money that is transferred over from some other source, a bank account, and then use that balance for purchases and, in return, receive some cashback rewards. Have I got it right?
That is right. And, the funny thing with this is, it actually goes back to my early days as an employee of Burger King when I was, it was a few years ago. But you may remember the same thing applied in the US. When you used to use your card back in those days, there was this question: press 1 for debit, press 2 for credit. And the fact that cards worked that way was very healthy because it reduced the debt that you were just reporting on. Because if you put some of your transactions on your debit account and some on credit, your bill at the end of the month was smaller and you were less likely to revolve and build up debt. But then the banks removed that for a good reason, because it made them more money, but for the bad reason, the consumers started ending up in more debt. And so the ambition of Klarna ever since the beginning has been to provide better, more healthy, interest-free credit option, but also the debit. And actually, even today, 30% of our volume on our network that processes over $100 billion globally annually is already debit. And now we're also adding this feature to actually store, money on our accounts to spend that money.
That feels.
What's a little bit unfortunate.
Go ahead. I'm sorry, I interrupted you. I beg your pardon. Go ahead.
No. The last thing is just what's a bit unfortunate to me is in Europe, even further than in the US now, we also be able to offer up to 3.5% interest on that money. That's not yet there in the US, but hopefully over time we'll be able to do something similar.
So in Europe, this would be an interest-bearing account in addition to a convenience account. Let me understand the cashback portion of it. I assume that what you have are arrangements with retailers, service providers, and others to accept your service as a form of payment. Is that correct? And then as a subset of that, there would be some who would be willing to help you subsidize cash back to your cardholders or participants, right?
No, that's exactly it. I mean, I think the way people think about us as a buy now, pay later company, but the way I think about it is we're a third-party network, right? So you've traditionally had full-party networks, Visa and MasterCard, and you had third-party networks like American Express and to some degree PayPal. And the benefit of Klarna is in that network. I mean, almost over 50 of the top 100 US retailers now offer Klarna online. And that obviously has driven us to over 30 million consumers using the service, and they can use it more frequently. And they want to use it for both debit and credit. It's predominantly in the US still credit-based, but it's, over time, our ambition is now to grow on the debit. What's also interesting is in the US, debit is still extremely expensive for retailers. In Europe, we're talking about 20, 30 bips. In the US, they pay 150 bips. So the debit size also is an extreme opportunity for somebody coming from a much more cost-conscious environment to compete on the debit space.
Well, that is a big difference here. I think increasingly retailers are resisting the transaction fees that the transaction companies are charging, whether it's on a credit card or a debit card. Talk to me about buy now, pay later, and what your delinquency rate is or your bad debt rate is on those loans.
Yeah, so the thing, again, since it is actually a healthier form of credit compared to a credit card, because of that option of debit and credit, because you always pay back in installments, and revolving is a very confusing concept for most consumers. You never really know when you're going to pay it back. So fixed installments, zero interest, means that the average outstanding credit for Klarna is $100, $200 versus $5,500 on a credit card account. And the interest rate is obviously zero. So as a consequence, we attract a very conscious, what we call self-aware avoiders. People who have been burned by the credit card industry who want prefer debit, but they want occasionally to use credit. And that audience has been estimated by McKinsey to be about 20% of the US population. So I'm not surprised to see the growth of that. And the losses in that population are actually, the loss that we see by underwriting in real time are about, 20, 30% below credit card industry standards. So over time, it's just a healthier way. And that means that you are going to have lower losses than you'll see in typical credit card portfolios.
There is rumor that you're going to IPO here in the United States at some point, maybe later this year, maybe not. What can you tell us about that? What are your objectives in terms of a capital raise? And can you give us any hints about timing?
Well, yeah, I think that, for us, coming back actually I was looking at your funny episode about Waymo, which was just so funny to see. And I had the opportunity being in San Francisco this summer with the kids to actually experience Waymo myself, which is amazing. But I just to think about this self-driving cars, like, it used to be a big thing a few years ago. Everybody talked about it, and now it's actually happening. We believe in the digital financial AI-powered assistant that's going to replace the current incumbents of banking and disrupt the banking industry. And we want to be one of those players. And part of that strategy was always to become global, and part of that would needed success in the US. Now, as we have over 30 million users in the US, we have almost, over $1 billion of revenue in the US, and we have gross profitability and profit in the US. We've kind of, checked the boxes that we thought were prerequisites for a successful IPO, but we still have so much growth ahead of ourselves. We're still there's still so much opportunity in the US and globally speaking. So I think kind of all the stars are there. It's just a question now of market conditions and preparations. We're fully regulated banks. We already disclose financials on a quarterly basis. A lot of the kind of traditional structures that you would expect to have to be built up are there. So, all the prerequisites are there. It's just a question of when.